Microsoft just posted a staggering $90 billion in revenue for their fourth quarter. But the real story is how they're quietly shifting their accounting to swallow a colossal AI hardware bill. Welcome to Earnings Unscripted.
It's July 29th, 2026, and we're looking at MSFT today.
It's really an absolute machine right now. That top line is up 18% year over year, and demand just continues to outstrip their actual physical supply of servers.
Exactly, and the bottom line reflects it. Earnings came in at $4.81 a share, which is comfortably up from the previous quarter. Plus, they clearly caught the street's attention, right? Looking at the tape after hours, it gapped up hard during the actual call.
I'm afraid it absolutely did. The regular trading session was completely dead, but once management started talking, the stock broke out and finished up over 8%.
And just a quick note before we get into the weeds here, we're only sharing our personal opinions on the market, so please don't treat our banter as actual investment advice.
Right, please don't. But you really see why the market got so excited when you look at how this tech is hitting the real world. There's this crazy anecdote from their call about the UK's National Health Service. They rolled Copilot out to a massive chunk of their staff because a trial proved it was saving clinicians nearly an hour every single day.
Right. It's officially shifting from testing to widespread deployment. But honestly, the craziest part of the print to me isn't even their own internal AI. It's where else they're placing chips.
What do you mean?
Well, everyone fixates on the OpenAI partnership, but if you look closely at their GAAP net income, there's a quiet $3.2 billion gain sitting there for mistaken Anthropic.
Wait. Anthropic? That's OpenAI's direct rival.
Exactly. Nadella isn't just betting on one horse. He's trying to own the entire track. They're funding the competition and scoring massive investment gains doing it. It's just a totally ruthless but brilliant diversification strategy.
That's wild. Okay, but you mentioned earlier they're buying all these servers to fuel everything, and operating expenses are clearly jumping. So if capital expenditures are skyrocketing next quarter, how exactly are they keeping margins so stable? Because I saw something about them suddenly extending the lifespan of their data centers, and I need to know if that's actually legit or just an accounting flex.
It's absolutely an accounting flex. They're stretching is a better word. They're stretching the useful life of their data centers and office buildings from 15 to 25 years.
Hold on, walk me through that. So they buy a bunch of servers, and instead of writing off the expense over a decade and a half, they just spread the pain out over a quarter century? Doesn't that artificially inflate their profits today?
Bingo. The cash outflow still happens immediately, but that depreciation drag on their operating income gets smoothed out over time. It keeps the margins looking stable on paper while they're secretly on an absolute spending spree.
Okay, but how much cash are we actually talking about here?
It's staggering. Amy Hood guided that next quarter, quote, "We expect CapEx spend will be over $50 billion, including the lease reclassification impact from the useful life update."
That much in a single quarter, just on infrastructure?
Right. And to put that number in perspective, their operating cash flow for this entire quarter was roughly $55 billion. So they're taking almost every dollar the company generates and plugging it straight back into AI hardware.
That's terrifying. If I'm looking at a regular company betting its entire cash stream on servers, I'd panic. Why isn't Wall Street freaking out?
Because the bet's paying off instantly. The market's perfectly fine with it since Azure demand's totally unconstrained. Every time Microsoft makes their server fleet even slightly more efficient, they immediately sell that freed up compute capacity. Hood actually framed it directly, saying, quote, "Because of the supply-demand imbalance we've been talking about, when we can make efficiency gains, they are quickly monetized in the quarter."
Love that. Quickly monetized. That's just a polite corporate translation for we literally can't plug these GPUs in fast enough.
Exactly. It's an efficiency cash machine. But here's the truly ruthless part about how they fund it. Operating expenses jumped 10%, mostly for compute capacity and AI talent, but their overall headcount shrank by 2%.
Wait, they cut jobs overall while expenses spiked? So they're quietly shedding legacy employees to pay for the new AI talent.
That's the mathematical conclusion. Absolute brutal cost discipline underneath the surface. And honestly, it fits a pattern this quarter of controlling the narrative. They even started reporting non-GAAP metrics that specifically exclude a $480 million drag from their OpenAI investments.
Oh, that's clever. So they're just siloing off the messy venture capital stuff from their clean cloud margins.
Yep, they're telling investors to judge the pristine software business separately from the venture bets.
It's a masterclass in narrative control. But this can't all be perfect, Miro. If the cloud side acts like a giant ATM right now, what's quietly bleeding out the back door?
Gaming, specifically their Xbox hardware, it's practically a structural anchor at this point. Hardware revenue just cratered, down 33% year over year, and that's on top of impairment charges and severance.
Down a full third? Wow. I mean, that's a brutal drop, especially when you contrast it with that absolute rocket ship happening over in the server farms. So are they just dragging it along for sentimental value?
Not quite, but they're clearly managing a decline. Satya actually tried to address it saying, quote, "When it comes to Xbox, we are making the necessary decisions required to reset the business for long-term growth and expect to return the business to growth in fiscal 2027. But honestly, that sounds like a long winter for the personal computing side.
Right. Necessary decisions is really just a polite way of saying they're cleaning house.
Still, even with that gaming drag, they must feel pretty good about their overall momentum, right? What's the actual forecast looking ahead?
They're incredibly confident. Management guided first quarter revenue somewhere between, I think, $89.85 and $90.95 billion. So they're basically forecasting an acceleration on the commercial side, completely unbothered by that PC market sluggishness.
So with that much commercial growth projected, they're really banking on this AI rollout getting much deeper into enterprises.
Exactly. And they're explicitly changing the terminology now. They aren't just talking about Copilot seats anymore. The big phrase this quarter was agentic platforms. They actually mentioned having over 40 million registered agents built on their system already.
Wait, so agentic platforms? You mean instead of a human typing a prompt into a chatbot, the software is just taking actions on its own inside the company network?
Precisely. It's a fundamental shift from chat to autonomy. Satya framed it perfectly on the call. He said, at the end of the day, if a firm is a learning machine, they need their own learning machine. So they don't just want to sell you a cloud subscription anymore. They're trying to become the operating system for your entire company.
Okay, the operating system for your entire company. Okay, that's slightly terrifying, but I completely see why the street loves it. They'll just keep building the learning machines and we'll keep trying to make sense of the math.
Always a pleasure. Catch you later.
Consider hitting subscribe in your app to catch our next breakdown without having to search for it. Since we just spent the whole episode analyzing Microsoft's learning machines, it's probably a good time to mention that Miro and I are completely synthetic voices, and this entire podcast was written by AI to go from the earnings call to your headphones on the very same day. Shoot any feedback or ticker requests over to earningsunscripted@datamadness.ca, and you can find our X link in the show notes.
See you all next time.